Equity compensation has become one of the most popular ways to keep employees incentivized, keep them there, reward them, and give them kind of a share of the company so they want good things to happen, profitability, and for their work to honestly matter a little bit more. And one of the most common forms of equity comp is RSUs. And so today we're going to talk a little bit about what RSUs are, some of the key terms that you need to understand, as well as use Eli Lilly as a company because that's a company near me. So what RSUs are is they're called the restricted stock units. So basically what that means is your company, in this example, Eli Lilly, will say, hey, we're going to give you 10,000 shares of Eli Lilly stock, and it's going to vest over 4 years. And so what that means is that until those years happen, the RSUs are meaningless. Like those shares are not yours. They have no value. But what happens is at year one, 25% of those 10,000 will vest. And so you'll get 2,500. At year two, you'll get another 2,500 and so on until all 10,000 become yours. The important thing to note is if you left after year two, you would only have those first 5,000 shares. You would never get the remaining 5,000 shares. And obviously you wouldn't get that many shares. We're just trying to use simple numbers to make the example easier for you to understand. What we just talked about there is the vesting date. And that's really important because you want to ensure that, hey, I know how long I have to work here to receive those shares, because if I end up leaving beforehand, they actually are worthless. So what are things that you need to know about RSUs? So every year when they vest, you don't have to do anything. You don't have to buy anything. You have to go in and accept them early on that you do want the RSUs, but you don't actually have to do anything when they vest. So let's say January 1, you're going to have 2,500 shares vest. What happens is those become yours that day. And here's the key thing that you need to understand. On that day, you are going to be taxed. You're going to be taxed at your income rate. The key thing here is that they don't necessarily know what it is. Sometimes they flat and only withhold 22% taxes when some of you could be in 32% or 34 or 37% tax bracket. So you're going to want to do some tax planning here and ensure that you have saved enough on taxes. So when tax time comes in April of next year, you aren't short on the money and don't know what to do. But the way that you want to view RSUs are basically as a cash bonus. Since the day they vest, they become yours and that tax is already paid. You basically are given that amount of dollars and you're set to say, hey, do I want to continue to buy and hold on to Eli Lilly stock even though I have no more tax? So if I sold on this day because there wouldn't be any gain, I wouldn't have any additional tax. Do I still want to hold on to Eli Lilly shares, or would I rather go invest elsewhere in something different? And this is something people overlook because they're like, well, I want to hold on for a year to get long-term capital gains tax rates, which are lower than income, but you already paid the income tax on the day that those RSUs vested. So you now want to sit here and say, would I rather invest in something else with this money, or would I rather hold on to my company stock? That is totally up to you. And you just want to make sure that you're diversified, that you hold on to good companies or quality diversified ETFs. But RSUs are honestly really simple. So to kind of go back through, you're going to have a vesting date, which means when those RSUs become yours. When those RSUs become yours, that tax is due at your income rate. And then choosing to hold on is all based on, do I believe in this? And would this be the number one thing I would invest in? If I would have rather invest in something else with that money, then I would move that money somewhere else. And then if you continue to hold on, if you sell within 1 year, you're going to pay tax again at your income rate. If you hold for greater than 1 year, then you're going to pay tax at long-term capital gains, which is 0, 15, or 20%, which is more favorable. Obviously, looking for a company that has RSUs is really great. It's an added benefit. It's more compensation. It's all a part of your package in a way to keep you there. So I hope this better helps you understand how RSUs work.